You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Today, we're just going to jump right into a trade. Last week, we looked at potential hedge strategies. Specifically, we looked at them in the FANG stocks. They've been very volatile recently. Just talked about different ways, different approaches to actually covered call selling. And we just looked at a whole different way of thinking as far as trying to protect a long stock position in your account. So you could almost just title that episode Options for the Stock Investor, because that's what it's all about. And that's actually where options started from, the need to enhance stock positions as opposed to speculate on market movement. But now it's a little bit of both in this day and age. So today, let's do a little speculation. And that's where we're going to, as always on Options Playbook Radio, nothing's ever meant to be a recommendation. But what we really try to cover is different market scenarios. We're picking strategies more off of the pricing mechanisms inside the market than on the actual forecast of the underlying. That's what Options Playbook Radio is all about. We never really have a view on direction. We're just trying to say, well, with this type of pricing conditions in the options world, what strategy might fit those conditions? And there's never a golden book of answers to go around with it. But bottom line is, that's our goal. That's what the whole show is about. That's what the premise is about. So I have one of those type of trades today. Today, we are taping Options Playbook Radio a little bit earlier than most days. We're going to do this. This is the 19th of June. It is a Wednesday. The market is open. The Fed's going to make a big announcement today, and they're a little bit on the fence as to if they're going to raise or lower rates. And they're going to be making that announcement here within a few hours of this taping. So if we're looking at a strategy to try to go along with what the Fed announcement is doing to the markets, to me that means we want to stay in a index, and specifically let's stay in the most quoted index out there, the S&P 500 index. And we're going to look at strategies based off of market conditions and the thinking of the marketplace that's going on right now. Okay, so Fed may increase rates, may not. There's really no, it's not a 100% this is what's going to happen. So implied volatility has remained a little bit high, even though we've had a pretty good rally. Right now, the VIX index was at $15.56 on the day, trading a little bit higher overall, just a smidgen. That gives us a little bit of premium, a little bit of juice in the option contracts, and that's always what makes option trading fun, especially in an index like the S&P 500 index, which is almost a 3,000-point index at this point in time. The last trade today on the S&P 500 index is 2,915.71. It's down $2.04 on the day. So we're concentrating more so on the VIX, and we're hoping that implied volatility will come down after this news. It is a Wednesday, so we're going to look at the June 21st expiration, which means these options have 2 full days worth of trading. Now, I want to emphasize in the SPX, expirations are a little tough because there are so many different expirations that are available. The weekly expirations will stop trading after the close on Friday the 21st, and the actual monthly expiration, the June 21st original option contract from back in the day, that stops trading on Thursday, the day before, and the price is set on the opening. So with that said, this index becomes a very interesting index to trade in that we have a lot of premium left in a couple of day option contract. We have a view where the Fed might say interest rates are going to go up or going to go down. We've had a fairly decent rally in the marketplace. So because of where the VIX is at and the fact that we got little juiced up option contracts even in the shorter term options, the June expiration, the implied volatility is up to around 19% on the options that we're looking to trade. So because of those scenarios, we're going to flip a coin and say we're going to go up or we're going to go down. We're going to pick down, and we're going to do a skip strike butterfly. And it's going to be a 2-day trade. It's going to be almost like a time bomb butterfly. And we're going to get this done for a net credit. So we're going to embed a credit spread by skipping a strike in the butterfly to help pay for our butterfly. And we're going to go right now. The market, like I said, is at 2,915, and we'll just round up 2,915. And the strike that we're going to be buying, which is going to be the main driver of our skip strike butterfly, is the 2,870 strike put option. That's 45 points away as far as the S&P 500 is concerned, or on a percentage basis, that is about 1.5%. All right. So could that market move that much? Yes, it could, without a doubt. One of the neat things about trading the Fed is the Fed usually announces their decision, and the market is still open. They're supposed to announce at approximately 2 o'clock today is when they're supposed to announce if they're going to increase or lower rates. And then you have the reaction right away, but you don't have the worries about the big gap opening or the big, to the upside or to the downside, because they don't do it after the markets. And that's what makes trading interesting in this index for Fed meetings. Exact reason why. Once again, don't have an opinion on what the Fed's going to do. We're just talking about what type of strategy might match the scenario that's going on in the marketplace. Okay, so we're going to be buying to open June 21st weekly expiration, 2870 puts, go down 10 points, and then sell 2 of the same expiration 2860 puts. Then we're going to go down and skip the 2850 and then buy the 2840 same expiration. At the midpoint, this could be done for a net credit of 35 cents to the account. There is a credit spread embedded into this butterfly, which is 10 points wide. So the margin is $1,000 on this trade. And also, the maximum that the spread can trade for is $1,000, which is the width from 2870 to 2860. You have 2 days for this to live and a couple of hours. As soon as the Fed announces, you got a couple of hours until the market closes, and then you have 2 full days worth of trading. And the fact that you can get this done for a net credit to the account means that if the market goes up or stays flat or trickles down, you can make that net credit of 35 cents to the account. Your best case scenario is if the market just kind of stayed flat and drifted lower and slowly went down towards that 2870 range and finished somewhere between 2870 and 2860. And by finish, I mean closer to the expiration date of June 21st. And if that does happen in that scenario, one thing that's nice about the S&P 500 index is that it's a cash-settled index. So you won't even have to trade out of it. All that would happen is, let's say, for example, the almost ideal scenario would be that the market would stop at 28.61, 1 point away from the short strike, and then the S&P 500 index put that you own, the 28.70, should be worth about $9 in that scenario. And then that means, if that's the settlement price at expiration, that $9 would just show up in cash in your account, or you can sell and you can close it. No problem. However you want to deal with the scenario. So that would be the ideal scenario. And you have 2 days for that whole trade to process. If you're dead wrong, the market does not come down at all, then you make 35 cents on the trade. Where you really get hurt is if the market goes below 28.50. Below 28.50. That's where we skipped that strike and embedded that credit spread. So from 29.15 to 28.50 is the risk, and that's basically 65 points. So if the market goes down 65 points, that's when we really start to get nervous about the trade. If that did happen, you would just close out of the trade. If it happened instantly, if it happened very quickly, the implied vols would probably increase, and that would protect you a little bit. So once again, we're doing this trade because of pricing, not because of the forecast. It's just an interesting way to trade around a Fed announcement. All right. So a lot to unpack there. Let me give you one last summary of the trade that we're looking to do, and then we'll move on to next week. So here we have. Right now, the market is open. It is June 19th. The Fed has not announced yet. The last trade in the S&P 500 index was 2,915. It's down just about $2 and some change. We're going to look at the June 21st expiration, the weekly expiration. We are going to do a skip strike butterfly, which means all the expirations are going to be the same. We're going to be buying to open 1 28.70 put, selling to open 2 28.60 puts, skipping the 28.50 put, and our protective put is going to be buying 1 of the 28.40 puts. Right now, the midpoint is 35 cents. If you can get a midpoint fill on this trade, that means we're bringing in a net credit of 35 cents to the account. There is a margin requirement. The margin requirement is created from skipping that strike, which is the 28.50 to the 28.40. It would be a $1,000 margin requirement. But then again, you do bring in 35 cents on that. That can help offset the cost of that margin requirement in your account. Max upside is $10, which the ideal scenario would be right at the expiration. The S&P 500 index would stop at your short strike and just sit there, which is the 28.60 strike. That's it for this episode of Options Playbook Radio. If you have any questions you would like me to answer, you can email them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy with an S at invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finished out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.